Hello, and welcome to QuantPy. In this demo, we explain the FX option pricing tool, instead of an example from a textbook. In this demo, we use market data, exchange-traded options data from CME, and OTC options quotes from Phoenix. Let's find the CME FX options tool first. We are obviously interested in the FX options. Let's select Euro USD. We have loads of options again. Let's try the June 2019 option contract. It has about 10 months to expiry. Cool, we have both inputs and outputs on the same page, and we are now going to replicate this in QuantPy. Recall, the CME options are on futures, not the spot rates, and to price options on futures, we use Black's formula instead of Black-Scholes. We do not need to worry too much about the differences between Black-Scholes and Black's formula, as by setting the foreign currency interest rate equal to the domestic currency interest rate, and replacing FX spot rate by the future price, Black-Scholes formula get transformed into Black's. You should put Black-Scholes and Black's formulae side by side to verify that this is indeed the case. Now we can happily input the CME inputs into the FX options tool. For spot, we enter the futures price as explained before. Strike price goes in as it is. We can compute the maturity by using the day count fraction tool. Let's enter the start and maturity dates. We will assume that the settlement period is 0, and the day count convention is actual, by 365. Here you go, the maturity is 292 days, which is 0.8 in years. CME is counting hours as well, that's why you see the fraction and number of days. Let's enter the maturity and volatility. The 2.64% is the USD interest rate. Recall that we need to set both currencies' interest rates to the USD rate here. This is because the CME options are options on futures, not spot, and we should be using Black's formula. We are ready to hit the button now. Here you go. The results are very similar. Notice that the Vega needs to be divided by 100, CME is quoting figures in percent. Also the theta will need to be divided by the number of days in a year, CME is reporting theta per day. That is for comparison with CME. Now let's try to find the OTC market data. Let's search for Reuters FX options screen. This is how the FX options are quoted in the market. We have the quotes for each maturity. Focusing on one maturity, say 1 year, you see we have at the money volatility, and 25 delta risk reversals, and strangles. We will ignore the 10 delta quotes. This Reuters screen is only from a demo, and contains out-of-date data, but we see they are sourcing the data from Phoenix. So let's visit Phoenix for the more recent data. Here we have the volatility quotes. We will continue with the Euro USD example. You can see the average of the ATM volatilities is 7.9%, which is luckily the same number we saw on the CME screen. The risk reversal is minus 120 basis points, and the strangle is about 33 basis points. You might ask, what do we do with these numbers? Well, we use them to interpolate the smile curve, which will then give the volatility for different levels of moneyness, which can be in terms of deltas or strike. Let's try the smile interpolation tool. The Euros USD as of today is 1.1439. We will use the USD interest rate from the previous demo, which was 2.64%. The Euro interest rate is roughly minus 25 basis points. We will assume maturity of 0.8, and that the volatility quotes for this maturity are the same as for 1 year. In practice, you will need to employ some form of interpolation. We read the volatility quotes directly from Phoenix. Here is the output. The first section shows how the at the money and the 25 delta quotes get translated into strike, volatility, and delta. Essentially, the three quotes give us three pairs of strikes, volatilities, deltas. We can use these to interpolate the smile, volatility as a function of strike, or volatility as a function of delta, which we show in the next section. Don't worry about the unusual shape of the first chart. This shape is because it covers a very wide range. The inputs quotes only cover this small region, over which the graph does look like a smile, and we will normally use to interpolate values within this range. We can use this graph to read volatility for any strike. Knowing the strike and volatility then enables us to compute delta for each level, which we do in the next chart. The next chart then gives volatility smile in terms of delta. Note in the FX market, moneyness is often quoted in terms of delta, so this chart is important. After all, Phoenix data we started with had volatility in terms of delta. We can read the volatility for any strike or delta now. Assume we have been asked to price a call option with a strike of 1.21. We can read the volatility from here. It is 7.7%. We can now go to the FX options price tool and enter all the inputs and this volatility to get the price. Let's enter the inputs into the FX options tool quickly. The first section gives the price and Greeks. The next section gives the various deltas. An adjusted delta with respect to the spot and forward rate, and premium adjusted versions of these, which as the name implies, adjust deltas by the amount of the premium. The next section then gives prices in different conventions. The Black-Scholes option price gives the price of an option with a notional of 1 unit of foreign currency. If one would like to have price in terms of 1 unit of domestic currency, then all you need to do is to assume that the notional is 1 divided by K at maturity. You then pay 1 unit of domestic currency, which is K times 1 over K, and receive 1 divided by K units of foreign currency. And that's all there is to it. We also give the prices in percent. If we have been asked to price an option with 1 strike only, then we can use another tool to get the interpolated value of the volatility for the given strike. We demonstrate it quickly here. And if we have been asked to quote price for an option with a specified delta, then we can use this tool to get the corresponding volatility. And finally, we show the FX price analysis tool, re-entering the inputs quickly. The first few sections contain the same outputs we saw before, but we have now added the delta profiles. One last thing about the volatility quotes, we have been assuming that the strangle data from Phoenix represents a smiled strangle. A smiled strangle is defined as the difference between the average volatilities of the given delta put and call options and at the money volatility. In reality, the strangle usually represents a market strangle, which is slightly more complicated, though very intuitive. The market strangle, as one would expect, conveys the price of a portfolio of a put and a call option. The strikes of the put and the call can be easily calculated, because we already know the delta, which is 25, and adding the strangle to the ATM volatility gives us the required volatility. We use the same volatility for both call and put. Looking at the price of a call option, there is then only one unknown in the Black-Scholes, the strike of the call, which we can easily compute. We can do the same for a put. The problem that now arises is, our smile function must assign the same price to this combination of call and put, even though the very existence of risk reversal implies that our call and put will have different volatilities. Converting the market strangle into smile strangle via numerical root finding algorithm solves the problem. Luckily, QuantPy has a tool for that, which we quickly demonstrate now. In this instance, the difference between market and smile strangle is not very significant. However, if we go back and try a high risk reversal, then the difference would become more significant. Thank you for watching. You may want to practice with FX tools now, while it is still fresh. We wish you a happy interaction with QuantPy.